Hey, thank you for taking the time to click on today's video. I want to address a question that I hear pretty frequently as a fiduciary when a person who is not my client comes in and they understand that they're watching the value in their brokerage accounts continue to dwindle and decline. They're being affected by the volatility in the stock market. They're watching the nightly news and it's only increasing the anxiety that they're feeling about their potential to be able to retire. The question that I hear so very often is, Matthew, is it too late for me to make a risk reduction? Maybe you've been thinking the exact same thing. Well, to answer this, what I believe would be helpful is to actually go back in time, back in history, to look at what has already occurred and then maybe consider your question in the context of past history. And the reason I do this is very simple. Do you believe that in general, more often than not, history tends to repeat itself? I believe that it does. Generationally, things can change. Yes, we know that. But in reality, since the Garden of Eden, human beings have always been motivated in the same way. They're either motivated by fear or they're motivated by greed. And this is especially true when we look in the stock market because it's not a logical place, it's a very emotional place. So just consider this for a moment. If we go back in time to the turn of the century and we're looking at the year of 2000. In 2000, the stock market was at an all-time high. It had never been this high. And we also know from history that in 2000, this was the beginning of what was referred to as the dot-com bubble. This was the tech bubble burst. And what happened from 2000 to 2003 was that the stock market ended up losing, this is the S&P 500, 50%. Now, I want you to think about this. If you were the retiree that retires in 2000 and now you're retired, you're reliant upon the money that you've worked so hard to save for supplementing your retirement, and the market is going down, you would have been asking this same exact question. Now, did the market recover? Of course the market recovered, but the reality is that it did not recover until 2007. So it takes 7 years from this point to recover. Now, you may be thinking to yourself, I've already lost 20%. Well, is that too much? Well, I want you to think about it in a different context. You see, I had individuals that came into my office in 2007 and said, Matthew, you know what? It's okay. I've got the same amount of money. I made all my money back. But did you really? Because you see, between this point and this point, there was a 21% inflation erosion. That means that your $100,000 no longer bought $100,000. Now your $100,000 only bought $79,000 because you lost to inflation. And not only that, the reason that I always talk about making certain that your allocation is proper for the stage of life that you're in is that when we're investing in growth-based tools, whether that's individual stocks, whether that's mutual funds, index funds, that's okay when we're in the growth-based stage of our life, when we're in the accumulation stage. But once we get to the distribution stage, we need to be thinking about, how am I going to get income from what I've saved? You see, this is the reason why we need to make that transition to income-producing instruments, things that are more contractual. Because as the market declines, you're going to cannibalize your principal faster. Your principal shares are becoming worth less, and you're having to sell those shares to get that income. So you need $100. The shares are $10 a share. You're selling 10 shares. But what happens when the shares are now worth $5 a share? Now you're selling twice the number of shares just to get the same amount of income each and every month. So the question becomes, Matthew, today we see the Fed's raising interest rates. We've seen the stock market absolutely just devastated by all sorts of volatility. We're down on average 20, 25, 30% depending upon the index. Is it too late for me to make a risk reduction? After all, Matthew, I don't want to sell today and guarantee myself the loss. Well, let's just take a different perspective looking at this, and let's ask this question. Let's say that you were in stocks. Let's say that you were in fixed income instruments, things like bonds or preferreds. And so you had a nice diversification, a blend in fixed income type instruments and dividend paying stocks in 2000. And the market is declining. This means that the bonds are becoming worth less. This means that the stocks are becoming worth less. But there's one key difference. Because these are instruments that are producing and generating income, we'll just say on average 4%. Now you're in a totally different position, because even though the value of those instruments are down, the amount of income that you're receiving from them is able to supplement your income. And you're not having to sell any shares, or if you are having to sell some shares, you're only having to sell a little bit of principal. You see, this is the reason why we want to be so absolutely careful with our money, and in particular, the allocation that we choose. Making certain that the allocation and how we have our money positioned is appropriate for the stage of life that we're in. Because, you see, there really is consequences of waiting. If you're waiting for the market to recover, you're waiting for all the stars to align, it could lead you to a point where you have to wait a very long time before that occurs. And my question to you is this: how much are you losing to inflation during that period of time? How much income are you missing out? It's what's called lost opportunity cost. If I can maybe take my money out, and yeah, I'm down 20%, but I know that I'm ahead overall, and I'm able to now reposition that money into things that are safer, things that are going to produce for me 4, 5, 6% in interest and dividends. Even though I might have 20% less in principal, but I'm getting 3 times the amount of output. Is that not helpful for my retirement? So if your question emotionally, mentally, in your very gut is today, is it really worth, Matthew, making that transition to safety even though I'm down? I'll let you answer that question for yourself. Do you want to have to wait? Do you want to have to lose to inflation? Or would you prefer to keep your principal safer and be able to have income, which may be something you don't have right now? I hope this video has been nice and helpful to you. If you like this little video, we always appreciate the thumbs up. Hit that subscribe button down there. We'll let you know when we have new videos. And I do also encourage you, share this with your friends so that they can consider for themselves the true consequences of waiting to make a risk reduction. Thanks so much for watching, and remember, it's up to you to make today a great day.